Hello and welcome back to Business Matters at the Hindu with me, K. Bharat Kumar. Last week, there was talk in Parliament of bad loans, the amounts that were written off by banks, the amounts that were recovered. So there are some interesting numbers, but before we get to that, what is a bad loan? A bad loan is that which has not been serviced for a while. When I say serviced, depending on the contract agreement that you have with the bank, you have to pay interest, interest plus principal, or sometimes the bank can give you a moratorium because, for example, at the retail level, if you and I go for an educational loan with the bank says, you know what, for the first 2 years if the individual student is going abroad for studies, for the first 2 years you don't need to pay interest. But the meter keeps ticking. As far as the bank is concerned, the interest keeps accumulating, but the borrower does not have to make any payments for the first 2 years. And then, for the remaining period, maybe a 7-year loan, from the third year onwards, you start paying interest plus a small amount of principal, so that in the agreed upon duration, the whole loan is repaid with interest. When a borrower has not paid interest for, in the Indian context, it's 90 days as per norms, the bank has to tag this as an NPA, a stressed asset or a non-performing asset. Then beyond that period, after a certain period of time, if it's still not being serviced, the loan, neither interest nor principal is being repaid, the bank has to start recognizing that the possibility of the loan being paid back is coming down over time. So it has to start what is called providing for these loans. So in a particular quarter, if I had taken a loan for 100 rupees, for example, and beyond those 90 days, in a particular quarter, the bank says, okay, let me start providing for this loan. And it starts providing for 20 rupees, 20%. And then beyond that period, it says another 30% because there's no sign of this loan being paid back. And as mandated by regulations, over time, it completely provides for the whole loan. It's as good as telling itself that even if in the off chance that the loan comes back to the bank, right now, I as a bank am recognizing that this may not come back. So I'm giving the most conservative picture of my financial health to my investors and regulators. When a bank provides for part or all of a loan in a particular quarter, and the loan may have been taken much earlier, 6 months, 1 year earlier, when it provides for the loan in a particular quarter, it impacts the profitability of the bank in that quarter. And over time, as mandated by norms, when it provides for the entire 100% of the loan, and even then there is little sign of the loan coming back, being repaid to the bank, it says it's time to write off the loan. A write-off means taking it off the books of the bank. What does that mean? Some of us may know that a balance sheet in any company, bank and so on, would have a liability side and an asset side. When you give out a loan, that is an asset to you because it is returnable to you. Somebody owes you something. So loans given out by a bank are typically there on the asset side. When there is no sign of the loan being serviced and there's no sign of generating income and it's been provided for 100%, the bank takes it off the asset side completely. So its balance sheet is clean now, and that's the picture it shows to regulators and investors. Now we come to the interesting part when it comes to terminology. Writing off a loan is not forgiveness of a loan. The bank is not giving a clean chit to the borrower. We'll see how that works. Forgiveness of a loan is very different. Like if you have a house help or say a driver in your house or a gardener or somebody who you know needs your help and you give them 5,000 rupees as a loan. And you expect them to return it to you monthly, a small portion, till the whole loan is paid back to you. But that does not happen. And you know that that person is struggling. I mean, his or her intent to give back the money is there, but he or she is unable to. Then you say, you know what, I can afford this. I'm going to say, don't pay back. I understand. Okay, you just continue with working with me or whatever. And it's all right if you don't pay back the loan. That is forgiveness. A bank never, or at least rarely does that. Even if it has written off the loan completely from its books, its shareholders, the bank's shareholders, expect it to go after the borrower and pursue legal means to make sure that part or all of that loan comes back into the bank's books. So this is the difference. Like we said, the bank has a bounden duty to pursue all legal means to make sure that the loan is repaid back to it in full. It could start off with negotiations for settlements across the table. In the case of corporate borrowers, saying the example of corporate, because a good chunk of loans or credit given out is for the corporate sector by the Indian banking system. So earlier, the banks had recourse to channels under the SARFAESI Act or through debt recovery tribunals and so on, with which they could attempt to get back part or whole of the loan. Now, since 2016, the Insolvency and Bankruptcy Code has been put into action, and company law tribunals are in place to make sure that these negotiations happen and there is a resolution professional appointed, and then lenders agree to a new buyer marking a certain value, mostly a discounted value for the assets that could be sold to them, and so on. Banks can also sell these stressed assets to asset reconstruction companies. To put it very simplistically, if the value of the loan outstanding for a bank is, say, 100 rupees, the ARC or the asset reconstruction company says, you know what, I believe that I can extract 40 rupees worth in this loan if I go after the borrower. So bank, why don't you sell me this asset, and it'll go clean off your books and you have a fresh slate to start on again. What will it buy it at? Maybe 25 rupees, 30 rupees, just as an example. These ratios don't apply completely identically in the real world, but the bank says, you know what, I don't want to have the headache of pursuing a borrower. So let me just sell it to the asset reconstruction company for a certain value. Maybe it comes at a discount. At least I get something out of it. Back in 2021, that is last year, October 2021, the government of India unveiled the National Asset Reconstruction Company Limited with the intent to transfer 90,000 crore worth of toxic assets in the banking system that had already been provided for. In 2009, the Reserve Bank of India put out a master circular that set out exactly how NPAs must be treated as they age. Aging of bad loans is a problem. After all, if somebody has not paid you for 3 months, you're willing to wait, maybe, like we said, mark off 20 rupees out of 100 rupees outstanding from your books. But as it ages, it becomes 6 months, 9 months, 1 year, maybe 3 years. Then there is less and less certainty that that loan can be paid back to you in part or in full. So the RBI put out certain norms in 2009. In October 2021, it revised those norms, making them far more stringent. As per the circular put out in 2021, the period for which the advances remained in doubtful category, doubtful meaning there is little certainty that the loan would come back to the bank. If the age is up to 1 year, then the bank has to provide for 25% of that loan. And then the second category is 1 to 3 years, which is a total of 40%. And if that loan has been outstanding for more than 3 years, then you have to provision for 100% of the loan. Interestingly, even if the asset is categorized standard, which means it's being serviced properly, payment of interest and or principal has been made, and there is no problem with it as far as the bank is concerned, the RBI still expects banks to make provisions depending on the risk element for that sector. Like, for example, home loans with teaser rates, which means, for the next 3 months, we'll give you a certain lower rate, but if you miss that deadline, then the rates will be higher. So the bank hopes to get in borrowers within those first 3 months, which means slightly lower rates. So the RBI recognizes that these are probably at greater risk. So which means provisions have to be made for such loans. And there are several categories. For details, you can look at this website. For example, farm credit to agricultural activities, individual housing loans, and small and micro enterprises, and so on. In the last 5 years, how much have banks had to mark as bad loans or NPA in the Indian financial system? Earlier this month, the Ministry of Finance told the Rajya Sabha that loans written off by scheduled commercial banks during the last 5 financial years totaled just about rupees 10 lakh crore. If you look at the accompanying chart, the years ended 2018-19, 19-20 and 2021, these had exceeded 2 lakh crore per year. And the last financial year, FY22, was slightly lower at 1.74 lakh crore. And how much of these have been recovered by banks? Significantly, only rupees 1.32 lakh crore have been recovered, as you can see from the accompanying chart. As a percentage of write-offs, this comes to only about 13%. While bankers feel that this is certainly low, much lower than their expectation, one explanation is that if an NPA is fully recognized in a particular year, even the fastest of legal processes may not resolve for full payment within that year. So maybe there's a lag effect is their hope. Only time will tell whether recoveries would eventually improve. Recently, a college student aspiring to get into the banking system after graduation asked me why recognize NPAs at all. Good question. Assume that you are the owner of an electronics shop. You have laptops and mobile phones all on display, but only the outer covers are shiny and you hope to lure customers in with such a display, but the devices themselves are faulty, how would your customers feel after they buy this product from you? In the case of banks, not so much the customers, but the government and regulators need to have a fair and clear view of how healthy the financial system is. A weak financial system can lead to ruin and it could impact lives and livelihoods. So unless you know you have a problem and recognize it, how do you even fix it? India got aggressive in making sure that NPAs were recognized quickly, in time, and accurately. This was around the 2014-15 period. It did two things of consequence. The RBI, as a regulator, brought in what is called the Asset Quality Review, AQR, to make sure that, if you do this periodically and have a review of your assets and see how they are performing, there are no big surprises, especially large loans outstanding. You cannot suddenly say, I've been trying for 3-4 years, but nothing has happened, so this is a bad loan. So that there are no big surprises. After all, bank's core function is to be able to lend money and make money from the interest that it earns. If there is no interest forthcoming, then it's not doing its core function properly. So that was the idea. The second was to prevent the evergreening of loans. In the past, if you have large projects for which banks had lent and the promoter felt that, this project was not going right, so I'm unable to pay interest, principal, whatever, sometimes banks with good intent said, let me give more funds to this particular project in the hope that they can set this right. But that unfortunately rarely happened. The setting right rarely happened, and which means the loans kept getting evergreened. Explaining why these steps were critical, Dr. Raghuram Rajan, who was the RBI governor at the time that these changes were brought in, wrote to a parliamentary committee in 2018, quote, "To do deep surgery such as restructuring or writing down loans, the bank has to recognize it has a problem. Essentially, classify the asset as a non-performing asset. Think, therefore, of the NPA classification as an anesthetic that allows the bank to perform extensive necessary surgery to set the project back on its feet. If the bank wants to pretend that everything is all right with the loan, it can only apply band-aids. For any more drastic action would require NPA classification." So that brings us finally to the important question: has recognizing NPAs aggressively helped the Indian financial system? Replying to a question in the Rajya Sabha earlier this month, Finance Minister Nirmala Sitharaman said that with the transparent recognition of NPAs, this percentage for gross loans rose from 4.1% in March 2014 to 11.46% in March 2018. She said that with the government's strategy of recognition, resolution, recapitalization and reforms, NPAs had since declined to 5.9% by March this year. To the point on recapitalization, as an aside, it should be noted that the government infuses funds into government-owned banks or public sector banks when the banks are weak. The banks could have become weak for various reasons, one of them being poor lending practices, which impacts the capital that they have, that they could use to lend and make money on those. So if it does not have adequate capital, the government infuses funds indirectly or directly. The media reports have us believe that between FY11 and FY18, the government infused 1.12 trillion into weak banks in the Indian financial system. For the revised estimates for the budget presented the past February 2022, the government had committed to infusing 15,000 crore in select banks. This combination of accurate recognition of NPAs and getting them off banks' books and limited capital infusion where required has set the expectation that the Indian banking system is in a state of readiness to start lending to the corporate sector, even as economic growth is set to take off in India. When I say set to take off, I mean in the context of global slowdown. There is talk of a global slowdown and even talk of a recession in the EU and so on and so forth. I'm sure the coming months will give us more and more data on how much corporate credit from the Indian banks have grown, how much of that has been put into private capital expenditure that will eventually feed into growth, and so on. We will keep you posted. That is all we have for this week. Have a lovely week ahead and see you again next week.